The stock market right now is something you've probably never seen before. It's volatile, unpredictable, and frankly, a little crazy. If you've been paying attention, investment. You know what I'm talking about. Swinging hundreds of points in a single day, tech stocks soaring one week and collapsing the next, and investors reacting in ways that seem irrational. But here's the thing. Investment, this insanity is actually driven by very understandable forces. And if you pay attention, it can be an opportunity rather than a threat. First, let's talk about why volatility is off the charts. Markets hate uncertainty, investment. And we have a lot of it right now. Geopolitical tensions, shifting economic policies, and companies reporting earnings that either blow minds or disappoint at record levels. These factors are shaking the market constantly. It's not just noise. It's real money reacting to real events. For the average investor, this means two things. Your portfolio might swing wildly, but those swings also create chances to buy quality stocks at discounted prices if you're prepared. Understanding that volatility is a normal part of the current market cycle is the first step in protecting yourself from panic-driven decisions. Then there's tech. The tech sector is leading the market craziness, and it's easy to see why. Companies in AI, cloud computing, and social media are not just profitable, they're dominating headlines. Investors are betting big on future growth, which can inflate stock prices beyond reasonable expectations in the short term. But at the same time, when growth slows or earnings disappoint, those same stocks can crash dramatically. The lesson here is simple. These high-flying stocks are not for the faint of heart. If you want exposure, focus on companies with strong fundamentals, long-term growth prospects, and a track record of weathering downturns. Now, let's not ignore the elephant in the room: interest rates and inflation. The Federal Reserve's decisions aren't just numbers on a page. They directly affect your returns. Higher interest rates make borrowing more expensive, which can slow company growth and cause stock prices to drop. Inflation erodes the value of your investments if you're not careful. This is why it's crucial to consider how your money is allocated. Diversification, including bonds or dividend-paying stocks, investment can shield you from some of these market swings while still allowing for growth. Finally, your strategy is everything right now. In a market this erratic, random buying and selling is a recipe for stress and losses. Instead, having a clear plan is essential. Decide your goals. Are you investing for short-term gains, long-term wealth, or retirement security? Set limits for buying and selling. Focus on companies with real value, investment, and stick to your plan even when headlines scream fear or greed. Remember, the market may be insane, but disciplined investors have always found a way to succeed. Right now, the stock market is chaotic, but that chaos is exactly what creates opportunity. If you understand why the market is behaving this way, pay attention to interest rates and inflation, focus on strong companies, and follow a disciplined strategy, you can navigate this insanity and come out ahead. The key is preparation, patience, and making decisions based on logic, not headlines. Right now, the stock market is swinging like never before, and it all comes down to extreme volatility. Volatility is simply a measure of how much stock prices go up and down in a short period, and we are seeing some of the wildest swings in decades. One day indexes are soaring hundreds of points, and the next, they are plummeting just as fast. For many investors, it feels like chaos, but this isn't random. It's a reflection of uncertainty in the world economy, in corporate performance, and in investor sentiment. Understanding why this is happening is critical because your reaction to volatility can make the difference between growing wealth and losing it. The first factor driving this volatility is economic uncertainty. We are living in a time when interest rates, inflation, and government policies are changing rapidly. Investors are constantly trying to adjust their expectations for company profits, borrowing costs, and consumer spending. Every piece of economic data, whether it's a jobs report, a GDP update, or an inflation number, causes a reaction in the market. And because global markets are interconnected, what happens in one country can trigger responses halfway across the world. This interconnectedness amplifies every piece of news, creating bigger swings in stock prices than we would see in a more stable environment. Second, investor psychology plays a huge role. Markets aren't just numbers on a screen. They are made up of millions of people making decisions based on fear, greed, and speculation. When uncertainty rises, fear takes over, and investors sell quickly to avoid losses, causing sudden drops. Conversely, when positive news appears, greed and optimism can push prices far higher than fundamentals justify. This emotional roller coaster magnifies volatility and can make the market appear insane to anyone not prepared for it. Recognizing this psychological element helps you remain calm and make rational decisions rather than reacting impulsively. Investment. Another key point is that modern trading technology accelerates these swings. High-frequency trading algorithms and instant news dissemination mean that markets react almost immediately to any news, magnifying every small shift. Investment. Whereas in the past, investors had hours or even days to respond, now a single tweet or a brief economic report can trigger massive movements. Understanding that the market moves faster than ever is crucial to positioning yourself correctly. Finally, volatility, while intimidating, also creates opportunity. These swings can be scary, but they also allow disciplined investors to buy quality stocks at discounted prices or sell overvalued positions before a downturn. Recognizing that volatility is a natural part of the market cycle allows you to stop worrying about every dip and start thinking strategically. By preparing for volatility with a clear plan, diversified investments, and patience, you can navigate these swings with confidence rather than fear. In short, extreme market volatility isn't something to panic about. It's a signal to get educated, stay disciplined, and focus on long-term strategy while others react emotionally. When we talk about why the stock market feels insane right now, we can't ignore tech stocks. They are the headline grabbers, the ones swinging the market dramatically, and they are a huge reason why both excitement and anxiety are at an all-time high. Companies in technology, think AI, cloud computing, social media, and semiconductor industries are growing fast and capturing enormous attention from investors. These are not just ordinary companies, they are the innovators shaping the future. Because of this, the market assigns them very high valuations, sometimes beyond what their current earnings justify. That combination of rapid growth and sky-high expectations creates an environment where stock prices can soar or drop hundreds of points seemingly overnight. One reason tech stocks dominate the craziness is their growth potential. Investors are betting not just on current profits, but on what these companies could become in 5, 10, or even 20 years. This long-term vision leads to extreme optimism. When earnings reports exceed expectations or when a company announces a new breakthrough, the stock can spike dramatically. Conversely, if results disappoint, even slightly, prices can fall just as quickly. This creates a high-risk, high-reward environment that fuels volatility and makes tech a double-edged sword for investors. Understanding this is crucial because if you're investing in tech, you have to be prepared for dramatic ups and downs and resist the urge to panic during a downturn. Another factor making tech stocks so volatile is speculation. Social media, investment forums, and instant news feeds can cause sudden surges in interest for certain companies, sometimes regardless of their fundamentals. Retail investors seeing a stock trending or hyped online can rush in, driving the price higher. This creates momentum that can last days or weeks, but it can collapse just as quickly when sentiment shifts. This is why timing and research matter more than ever. You need to understand what the company does, its long-term growth prospects, and whether the hype is supported by real performance. It's also important to remember that not all tech stocks are created equal. Some are established with predictable revenue streams and strong balance sheets, while others are newer and highly speculative and more prone to massive swings. Diversification within the tech sector can help manage risk. For example, pairing high growth but volatile companies with more stable tech giants can reduce the overall stress on your portfolio while still allowing you to benefit from innovation and growth. Finally, the madness in tech is also an opportunity. While volatility is risky, it's precisely this unpredictability that allows disciplined investors to enter at advantageous prices. If you have a clear strategy, patience, and focus on long-term growth, you can take advantage of dips without falling prey to emotional decisions. The key is preparation and understanding. Recognize that tech stocks will move rapidly, accept that some losses may happen in the short term, and focus on building a portfolio that balances risk and reward. In short, tech stocks are driving much of the current market insanity because of their growth potential, speculation, and sensitivity to news. But for investors who understand the forces at play and approach the sector strategically, this same volatility can become a source of opportunity rather than fear. ChatGPT said, one of the most important drivers of the current market chaos is the influence of interest rates and inflation. Many investors don't realize how much these two factors directly impact stock prices, yet they are at the core of the swings we're seeing today. Interest rates set by the Federal Reserve affect everything from the cost of borrowing for businesses to the returns on savings accounts and bonds. When interest rates rise, borrowing becomes more expensive for companies, which can slow down growth and reduce profits. This, in turn, puts downward pressure on stock prices. On the other hand, when rates are cut, borrowing costs decrease, companies can expand more easily, and stock prices often rise. Understanding this connection is crucial because it means that the stock market isn't just reacting to company performance, it's reacting to the broader economic environment. Inflation is another major factor shaping the market right now. When inflation rises, the value of money decreases, which affects both companies and consumers. Companies face higher costs for raw materials, wages, and operations, while consumers have less purchasing power. For investors, this can erode the real value of returns, especially if your portfolio is heavily weighted in cash or low-yield investments. Stocks are often seen as a hedge against inflation because companies can, in some cases, pass higher costs onto consumers. But the degree to which this is possible varies by industry, meaning that inflation can create winners and losers contributing to the overall volatility in the market. The interplay between interest rates and inflation is particularly critical. The Federal Reserve uses interest rate adjustments as a tool to control inflation investment, but these adjustments don't happen in isolation. They influence borrowing costs, consumer behavior, and investor sentiment simultaneously. When investors anticipate that rates will rise, they may sell off stocks preemptively, causing markets to dip even before any actual economic slowdown occurs. Conversely, the promise of lower rates can ignite buying frenzies. This constant back and forth creates a market environment that feels erratic and unpredictable. And even when the underlying trends are logical and understandable, it's also worth noting that timing matters in this environment. Investors who react emotionally to every report or Fed announcement can make costly mistakes, selling low in moments of panic or buying high out of excitement. The smarter approach is to assess how interest rate changes and inflation trends affect your investments over the medium to long term. Diversification becomes critical as certain sectors like utilities or consumer staples tend to be more resilient to rate hikes, while others like technology or real estate can be more sensitive. Understanding where your investments fall on this spectrum allows you to make strategic adjustments rather than reactive moves. Ultimately, interest rates and inflation are not abstract numbers. They are forces that shape the very foundation of investment returns. Recognizing their impact allows you to navigate a volatile market with clarity and purpose. By staying informed, assessing risk carefully, and adjusting your portfolio thoughtfully, you can protect your wealth and even take advantage of opportunities created by these economic shifts. In a time when the market feels insane, understanding interest rates and inflation gives you a lens to see through the chaos and make decisions grounded in reality rather than fear. Right now, with the market swinging unpredictably, your investment strategy matters more than ever. It's easy to get caught up in the excitement or fear that comes with wild market movements, but without a clear plan, those emotions can cost you dearly. A well-thought-out strategy provides a roadmap, helping you make rational decisions even when prices are moving rapidly. Whether you're a beginner or a seasoned investor, understanding your goals, risk tolerance, investment, and the types of investments that suit your portfolio is essential to navigating this insane market environment. The first step in creating a strong strategy is defining your goals. Are you investing for long-term wealth, retirement, or short-term gains? Your goals will determine your approach. Long-term investors can often withstand short-term volatility because they are focused on growth over years or decades. In contrast, if your objective is to make quick profits, you need to recognize that high-risk trades can backfire just as fast as they succeed. Clarifying your goals keeps you focused on the bigger picture, preventing impulsive decisions based on headlines or social media trends. Next, understanding your risk tolerance is critical. Every investor has a different capacity to handle losses or market swings. Some people can watch their portfolio drop 20% without panic, while others may feel compelled to sell at the first sign of decline. Knowing where you fall on this spectrum allows you to structure your portfolio accordingly. High volatility sectors like tech or emerging markets may suit those with higher risk tolerance, while more stable investments like dividend-paying stocks or index funds are better for those who prefer steadiness. By aligning your strategy with your comfort level, you reduce the chances of making emotionally driven mistakes. Diversification is another cornerstone of a resilient strategy. Spreading investments across different sectors, asset classes, and geographic regions helps mitigate the impact of a single underperforming stock or sector. In today's market, where tech, energy, and financial sectors can all behave differently in response to economic news, diversification isn't just a safety net, it's a necessity. It allows you to capture growth opportunities in one area while buffering against downturns in another, smoothing out overall portfolio performance. Finally, discipline is what separates successful investors from those who lose money during volatile periods. This means sticking to your plan, setting limits on buying and selling, and avoiding emotional reactions to short-term movements. It also means continuously reviewing your portfolio, staying informed about market conditions, and making adjustments based on logic rather than fear or hype. Tools like dollar cost averaging, which involves investing a fixed amount regularly regardless of market conditions, can help maintain discipline and reduce the risk of buying at the wrong time. In short, your strategy is your anchor in a turbulent market. Defining clear goals, understanding risk tolerance, diversifying wisely, and maintaining discipline are not just theoretical concepts. They are actionable steps that can protect your wealth and position you for long-term success. While the market may feel insane, a well-structured strategy turns unpredictability into opportunity, allowing you to invest confidently rather than react emotionally. In today's environment, strategy isn't optional. It's essential.